Financial analysis is the most important analysis for long-term stock investing. If you want to understand if a company is reasonably valued and financially strong, you don't have to look for hundreds of numbers. A handful of key financial ratios can tell you a lot. In this video, we will talk about 9 important financial ratios which an investor should be aware of. We will be covering price to book value, price to earning ratio, earning per share, return on capital employed, return on equity, debt to equity, current ratio, dividend yield, and PEG ratio. Each of these ratios answer a different question. Is the company expensive or cheap? Is the company generating good returns? How much debt it is carrying? Can it meet its short-term obligations? And perhaps most importantly, are you paying a reasonable price for the expected growth for the company? So let's break down these 9 ratios one by one. What they mean, how to interpret them, and why they matter when analyzing a company. Let's get started.
Would you buy a 500 rupees t-shirt for 1000 bucks? Probably not. The same logic applies for stocks as well. And that's where PE ratio comes in. PE or price to earning ratio tells us how much investors are willing to pay for every 1 rupee of company's annual earnings. Formula of PE ratio is share price by earning per share, also known as EPS. For example, if the share price of a company is 500 rupees and the EPS is 25, so the corresponding PE ratio will be 500 divided by 25, that's 20. That means the investors are paying 20 rupees for every 1 rupee the company is earning annually. A lower PE might indicate a stock is undervalued. But on the other hand, a higher PE may suggest future growth prospect for the company. But remember, a lower PE isn't always good and a higher PE is not always expensive. Always compare a company's PE with its industry peers and growth prospects. That's why experienced investors do not rely solely on PE. They combine it with other financial ratios. Two stocks worth 100 rupees and 1000 bucks. Which one will you buy? Not every 100 rupee stock is cheap. Similarly, not every 1000 rupee stock is expensive. To know if the stock is cheap or expensive, you need to look into the price to book value, also known as PB ratio. The PB ratio compares a company's share price with the value of its net assets. PB ratio is equals to share price divided by book value per share. Suppose the share price of a company is 300 rupees and its book value per share is 200. So the PB ratio will be 300 divided by 200, that will be 1.5. A PB ratio below 1 might suggest the company is undervalued or it might have some problem. On the other hand, a higher PB might suggest investors have confidence for future growth. The PB ratio works best for banks, financial institutions, or any asset-heavy business. Never invest on the basis of a single ratio. Always combine it with other financial ratios before investing.
Two companies can earn the same 100 CR profit, but that does not mean both the companies are equally attractive. That's where EPS or earning per share comes in. EPS tells us how much profit a company earns per each outstanding share. Outstanding shares are simply the total number of shares held by investors. Formula of EPS is equals to net profit divided by outstanding shares. If a company earns 100 CR and has 10 CR outstanding shares, then the EPS will be 10. In other words, the company generated a profit of 10 rupees per outstanding share. Generally, a higher EPS is a positive sign, which signifies company is generating more profit per share. But never judge a stock on the basis of only EPS. It has to be combined with other important financial ratios. EPS also needs to be compared with the company's earlier year EPS as well as the corresponding current EPS of its industry peers. Imagine you have invested 1 lakh in a friend's business. A year later, that business makes 20,000 profit. That's a 20% return on your investment. That's exactly what ROE or return on equity measures. ROE tells us how efficiently a company is managing its shareholders' money to generate profit. Formula of ROE is equals to net profit divided by shareholders' equity multiplied by 100. Example, if a company earns 20 CR net profit and has 100 CR of shareholders equity, then ROE is 20%. That means the company has generated 20% returns on the capital invested by the shareholders. In general, a higher ROE is better, but always compare companies within the same industry. Also remember, a high ROE is not always a good sign. It can sometimes be inflated due to high debt. So never judge a company only on the basis of its ROE. Always combine it with other important financial ratios. Two companies earn the same profit, but one of them uses half the capital to earn that profit. So which company is actually better? That's where return on capital employed or ROCE comes in. ROCE tells us how efficiently a company is using all its capital, including both the shareholders' money as well as the borrowed capital to generate the operating profit. ROCE is equals to EBIT divided by capital employed into 100. EBIT is the earnings before interest and taxes, and capital employed is equals to total assets minus current liabilities. Suppose a company has an EBIT of 20 CR and capital employed of the company is 100 CR, then ROCE is equals to 20%. That means the business is generating 20 rupees of operating profit for every 100 rupees invested in the business. The general understanding is higher the ROCE, more efficiently the company is using its capital. It's most useful while comparing companies within the same industry. ROCE considers both debt and equity, thus making it useful for evaluating capital intensive businesses. Two companies are making similar profits, but one of them is considered riskier than the other. The reason lies in the debt to equity ratio. The debt to equity ratio shows how much debt a company has compared to its shareholders' equity. Suppose a company has 100 CR in debt and 200 CR in shareholders' equity. So the debt to equity ratio will be 0.5. That means the company has 50 paise of debt for every 1 rupee invested by shareholders. In general, a lower DE means a company relies on less borrowed capital and is financially safer. But don't judge the number in isolation. Capital intensive industries like banking operate with higher debt. So the D ratio for company needs to be compared within the same industry. Imagine your bills are due today. Do you have enough cash to pay them? Companies face the same challenge. That's what exactly the current ratio measures. The current ratio tells us whether the company has enough assets to pay its current liabilities. Formula of current ratio is equals to current assets divided by current liability. For example, if a company has net assets of 200 CR and the corresponding liability is 100 CR, the current ratio is 2:1. That means the company has 2 rupees of assets for every 1 rupee of liability, which is a good sign for the company. As a thumb rule, current ratio above 1 is considered healthy. If the current ratio is below 1, it may indicate it has liquidity concerns. But if the current ratio is too high, it might mean the company is not using its assets efficiently. Like other financial ratios, current ratio should not be considered alone for the valuation of a company. It should be clubbed with other important financial matrices.
Do you know you can get a cashback just by buying and holding a stock? That's exactly what a dividend yield does. Dividend yield measures the annual dividend a company pays corresponding to its share price. In simple terms, it tells us how much cash dividend you are getting for every rupee invested in the stock. Formula of dividend yield is equals to annual dividend per share divided by current price per share multiplied by 100. Suppose a company is paying a dividend of 20 rupees per share and the share price is 400. So the corresponding dividend yield per share will be 5%. This means you will earn a 5% annual returns from dividend, excluding any gain or loss from the change of the stock price. A higher dividend yield is attractive, but it's not always better. So always evaluate dividend yield along with earnings, cash flow, and other financial matrices before making any investment decision. A high PE ratio does not always mean a stock is expensive. That's exactly why investors use PEG or PEG ratio. The PE ratio tells us how much you are paying for the company's earnings. The PEG ratio goes one step further by factoring in future growth prospect. Formula of PEG ratio is equals to PE ratio divided by expected annual earning growth rate. Let's take an example. Company A has a PE of 30, so the PEG ratio will be 1 and the expected growth rate is 30% per year. Now, company B has also a PE of 30, but the expected growth rate is only 10%. So the PEG ratio will be 3. Even though both the companies have the same PE, but company A is reasonably valued because of its higher growth prospect. As a thumb rule, PEG ratio below 1 may indicate the stock is undervalued. PEG ratio around 1 is considered fairly valued. PEG ratio above 1 may indicate the company is overvalued compared to its growth prospect. PEG ratio depends on future estimates, so it cannot be used as a sole indicator while making an investment decision. It has to be clubbed with other major financial ratios and concepts.
So, those were the 9 important financial ratios that can help you analyze a company's health from different angles. Remember, no single ratio can tell you whether the company is a good investment or not. P and PB ratio help you understand valuations. EPS tells you about earnings per share. ROE and ROCE help you analyze profitability and efficiency. Debt to equity tells you about leverage. Current ratio looks at short-term financial strength. Dividend yield tells you about your income you are getting from your investment. And PEG helps you look at valuation in relation to growth. The real power comes from putting all these ratios together and compare them with the company's past performance, industry peers, and the broader industry. If you found this video useful, please like and share the video. Subscribe to the channel for more videos on personal finance. If you want a PDF of all the ratios combined, just comment the word PDF in the comment section below and I will share across the complete PDF with you. You can also let us know the next topic you would like us to make a video on. Till then, stay tuned, stay updated, happy learning, cheers.